Welcome to the Pro Ticker Deep Dive. We are living through, well, an absolutely wild financial moment right now. I mean, on one hand, we are neck deep in a genuine technological revolution. This AI euphoria is everywhere, it's palpable. But what's truly astonishing is that the leading stocks, the heroes of this revolution, they're trading at valuation multiples that make even the notorious dot-com era look, well, restrained.
It's a dramatic tension, isn't it, between this massive technological promise and the fundamental discipline of math. And the stakes for you, the learner, are immense. We can quantify this extreme territory. Just look at specific examples. Palantir is trading at a shocking 242 times earnings.
242, wow.
And Tesla, 198 times. These aren't just high, they're, well, almost astronomical.
And it's not just individual names, right? When
Yeah.
we look at the entire market, the metrics are screaming historical.
It absolutely are. The S&P 500 forward priced earnings, or PE ratio, that's basically how much you pay today for a dollar of future projected earnings, it's sitting at 30.38.
30.38, okay.
That is over 56% above its historical average of like 19.4. This isn't just high, it's stratospheric territory.
Okay, let's maybe unpack those terms quickly just for clarity.
Yeah.
That standard PE is one thing, but what about the historical markers? I know you track the Shiller KPE ratio.
Exactly. And that's crucial. The Shiller KPE ratio is the cyclically adjusted PE. It's an important measure because it averages earnings over 10 years, so it smooths out the business cycle and removes temporary bubbles or dips.
Right, gives you a longer view.
Precisely. And right now it's at 39.51.
39.51.
That is the second highest reading in 154 years of market history.
Goodness. Okay, so that puts us firmly in extreme territory, right behind the very peak of 2000. So that becomes our central mission today, right? Can these stratospheric valuations actually hold, driven by this belief in infinite AI potential, or is gravity, about to reassert itself? We need to understand the bull case, driven by real earnings power, against the, let's say, sobering bear case, driven by ROI reality checks and historical math, to figure out where the greatest risks and opportunities really lie for you in this market. Let's start with the bull case, because the technological shift is, it's undeniable. It's what scholars like Robert Shiller call narrative economics, right?
The story is everything, absolutely. And the AI story is perhaps the biggest one we have ever seen. Narrative economics basically means that investors, consumers, businesses, we're all telling ourselves this powerful, self-reinforcing story about future productivity.
And the numbers backing that story are huge.
They are. McKinsey estimates AI could add up to $7 trillion to global GDP by 2030.
Yeah.
That isn't just hype. That's potentially the foundation for a platform shift that justifies, well, some pretty large numbers.
So if the numbers are so high, what's the core difference between this moment and, say, 1999? Because the valuations feel familiar.
Yeah, the feel is similar, but the critical differentiator is earnings power. The high flyers back in 1999 were often companies with strong concepts, but frankly, zero profits. They were burning cash rapidly.
Right, eyeballs over earnings.
Exactly. The current tech giants, the Magnificent Seven, they're not just innovative, they are absolute profit machines.
They offer a cushion, maybe? A cushion we simply didn't have 25 years ago?
Precisely. That's a good way to put it. In the first quarter of 2025, the Magnificent Seven reported 27.7% aggregate earnings growth.
27.7%.
That's nearly triple the S&P 500's aggregate growth rate of 9.4%. And take NVIDIA as a definitive example. The company is currently sitting on something like $500 billion in ship orders spanning the next 5 quarters.
$500 billion? That's...
Yeah, it's more than 3 times its trailing 12-month revenue. This spectacular earnings growth acts as a kind of safety valve. If the earnings keep compounding at that speed, the PE ratio naturally compresses over time, even if the stock price keeps climbing.
Okay, so the earnings story is incredibly powerful, a potential justification. But that cushion relies entirely on future execution and, critically, return on investment, or ROI. And this brings us to the skeptical side, the bear case. Where does the fundamental math start to push back on this powerful AI narrative?
Right, this is where we run into the sobering reality check. Despite all the excitement and the frankly massive CapEx spending we're seeing, we have some deeply worrying statistics suggesting capital allocation might be critically misplaced right now.
Misplaced how?
Well, an MIT study recently found that a staggering 95% of generative AI pilots at large enterprises are failing to deliver meaningful return on investment.
95% failure rate. That is breathtaking, especially given the, hundreds of billions being spent globally on AI integration. Does the study offer any insight into why? Is it technical limits? or something else?
It seems to be more of an execution and integration problem than a pure technology problem, from what we can tell. The tech works, basically, but adopting it requires this massive operational overhaul, talent acquisition,
Yeah.
which is proving incredibly slow and expensive for many companies.
So the reality on the ground is much harder than the hype.
It seems so. And the data on adoption confirms this kind of cooling effect. Large company AI adoption actually fell from a peak of 14% earlier in 2025, down to about 12% by late summer. Initial enthusiasm is clearly meeting some pragmatic reassessment.
And the timeline for payback isn't helping matters, I imagine?
No, not at all. Most executives surveyed expect satisfactory ROI only within 2 to 4 years. Now, that's vastly different from the typical expectation for tech investments, where you usually want or hope for a payback within, say, 7 to 12 months.
2 to 4 years versus 7 to 12 months. That difference in timeline raises a massive concern about the sheer scale of potential capital misallocation, especially if that 95% ROI failure rate holds up even partially.
Exactly.
And there's one analyst estimate we saw that suggests AI currently represents a capital misallocation equivalent to 6% of U.S. GDP. It's hard to wrap your head around a number that big.
It
right?
really is. That 6% figure only hits you, I think, when you put it into historical context.
Right.
The entire dot-com bubble, all that mania, it represented a capital misallocation of just 0.35% of GDP.
Maybe 3-5%. Okay.
And the 2008 housing crisis, which felt enormous, was about 0.4% of GDP. So this AI boom, if that estimate is correct, is potentially 17 times larger than the dot-com bubble's misallocation and 4 times larger than the housing crisis.
Wow. 17 times .com. If that figure is even close to accurate, how does that massive 6% practically manifest today? What does it look like?
Well, it manifests as structural waste, potentially. It's the, unused, overpriced cloud capacity companies are paying for. It's the bloated data center buildouts that aren't generating revenue yet. Or it's the massive expenditure on custom chips and data processing that doesn't translate into immediate, measurable productivity gains for shareholders. This tells you the systemic fragility we might be building if those earnings don't materialize reasonably quickly. And this potential fragility is compounded by the increasing market concentration risk. I mean, this structural vulnerability here is undeniable. The Magnificent Seven now represent 37.4% of the S&P 500.
37%. Up from what?
Up from just 12% back in 2015.
Wow. That makes the entire market incredibly dependent on the health of just a handful of names. As JP Morgan's chief global strategist admitted, this concentration makes some investors a little nervous. Well, for good reason, wouldn't you say? If just one or two of those names stumble, the ripple effects through passive index funds could be enormous.
Absolutely enormous.
But the question remains, if the ROI is so questionable and seems delayed, why are the giants like Google, Microsoft, Meta, Amazon, why are they all doubling down on CapEx? What market dynamic forces them to keep spending at such phenomenal rates?
That brings us directly to the concept of the prisoner's dilemma that really defines big tech competition right now. They are locked in a massive capital expenditure arms race.
A prisoner's dilemma. Explain that a bit.
Basically, each company fears that if they don't invest the massive amounts needed to secure the latest chips, build the biggest models, get the best infrastructure, they risk losing competitive position in AI forever. So they have to invest, almost regardless of whether the near-term returns are certain or not. It's a race just to keep up, driven by fear of falling behind.
And we are already seeing clear signals that investor patience might be wearing thin for these kinds of open-ended expenditures, aren't we?
We absolutely are. Look at Microsoft and Meta. They both announced higher spending intentions stretching into 2026. And what happened? Investors actually dumped shares in response.
Dumped shares after higher spending plans? That's counterintuitive for growth companies.
It is, and it's a powerful signal. The market seems to be becoming less willing to blindly fund uncertain, massive CapEx plans, even for these established blue-chip tech leaders. Patience has limits.
Okay, here's where it gets really telling, I think. Let's use Palantir as the ultimate valuation test case. The company reported phenomenal Q3 numbers. Revenue growth of 63%, securing $2.76 billion in new contracts, which is up 151%. Amazing numbers. Yet the stock fell after the announcement. How does that happen?
That's the critical divergence, isn't it, between operational strength and price. The valuation bar is simply set too high at 242 times earnings. They delivered amazing news, objectively, but it wasn't amazing enough to justify that price tag.
So the price already baked in perfection.
And then some. One publication even suggested that Palantir might be the most overvalued firm of all time. When stellar news can't push a stock higher, the price itself is telling you expectations were already priced for absolute, irreversible perfection and maybe beyond.
So we have the hype, the narrative, these astronomical valuations. But this forces us, and you, the listener, to be selective, right? We need to look beyond just the general AI stock label because clearly not all high multiples are created equal. This is where we need a better tool than just the standard PE ratio, I guess.
Exactly. This is where we need to move beyond just price to earnings and introduce the price to earnings growth ratio or PEG ratio.
PEG ratio, yeah.
The PEG ratio takes that PE ratio we talked about and divides it by the expected annual earnings growth rate. It is the crucial tool, really, to distinguish between an absurdly overvalued growth stock and one whose growth prospects might genuinely justify its current price, even if the PE looks high on its own.
What's the sort of rule the listener needs to remember for the PEG ratio? How do you interpret it?
Well, the general rule of thumb used by many analysts is that anything below 1.0 is often considered potentially undervalued or, at the very least, fairly priced relative to its expected growth. It suggests you're getting a reasonable deal on future earnings power.
Okay, below 1.0 is interesting. How does that apply to the current leaders in the AI infrastructure space then? Does it change the picture for them?
It completely changes the conversation for some of them. Take NVIDIA again. Its forward PE is around 41 times. Now, that looks high in isolation, right?
41 is pretty steep, yeah.
But its PEG ratio, when you factor in that massive expected growth driven by those huge chip orders we mentioned, sits well below 1.0. This suggests that its growth prospects are arguably strong enough to justify its current price. The market, according to this metric, may actually be underappreciating its future earnings power relative to its multiple.
So there are potential, let's call them value plays, even within the high-flying AI ecosystem if you use the right lens.
Absolutely. There are pockets. Look at Taiwan Semiconductor Manufacturing Company, TSMC. Crucial player, right?
Yeah.
It trades at a compelling PEG ratio of just 0.56, despite posting really strong 41% revenue growth in Q3.
0.56, that's quite low.
Or consider Micron Technology. They project something like 95.6% earnings growth over the next year, just huge growth, but currently have a forward PE of just 14.67.
Okay, so the immediate strategic takeaway here is that selectivity is absolutely crucial. You have to distinguish between companies with, say, sustainable competitive advantages and real earnings paths, and the speculative froth that is maybe purely riding on narrative momentum.
You must. And we also have to acknowledge the technical warnings because market technicians and historians, well, they're flashing some red signals right now.
Right, here is where history provides a potentially grim lesson on ignoring valuations for too long.
It certainly does.
Yeah.
Historical precedent is pretty clear. Every time the Shiller PE, that long-term measure we discussed, exceeded 30 for sustained periods, which really only happened in 1929 and again during the 1999-2000 peak severe market corrections followed. Eventually,
gravity kicks in.
And the math today suggests there's limited potential for prices to rise just based on multiples expanding further, people getting more optimistic and paying more for the same earnings.
In other words, prices realistically can only go up significantly from here if earnings genuinely deliver, not just because investors get even more enthusiastic than they already are.
Precisely. The S&P 500's current forward PE of around 24, maybe a bit higher now, suggests there is extremely limited multiple expansion potential left from current levels. This creates what we call an asymmetric risk profile.
Asymmetric meaning?
Meaning the potential upside feels more limited than the potential downside. Historical data shows that subsequent 12-month returns are typically pretty muted or even negative when the S&P 500 PE gets above 23 times. So you have limited upside driven by valuation expansion, but potentially substantial downside if earnings happen to disappoint those very high expectations.
And we are seeing some technical signs of market instability, or at least unease right now.
We are. The volatility index, the VIX, often called the fear gauge, it's been trending higher, hovering around 19 recently. That reflects, let's say, moderate investor unease, not panic, but definitely not complacency.
But perhaps the most concerning disconnect is what's happening within the Magnificent Seven group itself, isn't it?
Yes, that disconnect between their operational strength and their recent stock performance is key. Despite posting some of the strongest aggregate earnings growth in market history, as we noted, the Magnificent Seven as a group actually recently entered negative year-to-date territory.
Which tells you expectations were already impossibly optimistic, perhaps. When genuinely good news, record earnings, can't propel prices higher, the market is signaling that the valuation has likely overshot the fundamentals, at least for now.
That's a very strong signal.
And technically, analysts are watching key levels. If the S&P 500 falls past, say, 6,400, that's viewed as a 7 to 8% pullback. Manageable. But if it breaks below 5,800, professional traders see that as signifying a more consequential 15% correction that would likely truly shake investor confidence.
Those are definitely the levels people are watching.
So, stepping back from all the numbers, the ratios, the historical parallels, if this valuation cycle were, I don't know, a baseball game, where are we? Are we in the first inning of AI adoption or maybe the final innings of this particular valuation cycle?
That's the trillion-dollar question, isn't it? My sense is we're likely in the, let's say, seventh or eighth inning of this valuation cycle. To address the initial question directly, can high multiples persist amidst AI euphoria? Yes, they can, but likely only until growth disappoints significantly or the cost of capital gets repriced higher. The structural evidence, that 95% ROI failure rate in pilots, the CapEx arms race, the historical valuation ceilings, it all suggests that the easy money phase has probably been made, and the risk is now heavily weighted to the downside for the highest flyers.
Okay, so what does this all mean for you, the listener? What's the critical strategic implication to take away from this deep dive?
I think it has to be selectivity and survival. The great lesson from prior bubbles, including the dot-com era, is that the underlying technology often survives and thrives. But the momentum investors who chase the hype often don't.
Right. Think about Amazon, wasn't it? It lost something like 95% of its value from peak to trough back then.
Exactly. 95%. But for those who understood the long-term vision and held through the storm, it became one of history's greatest investments. The companies with structural moats, real earnings, and sensible paths to profitability will likely emerge stronger from any shakeout.
So the smartest bet, based on the data we've discussed, appears to be focusing on maybe the AI infrastructure plays, the ones with verifiable earnings, competitive advantages, and maybe reasonable multiples when viewed through that PEG ratio lens, like the TSMCs or perhaps even NVIDIA still, despite its run.
That seems prudent.
The strategy then becomes to aggressively avoid the pure speculative froth. Firms trading at 10 times their growth rate, or those requiring sustained 50% plus annual growth for years just to justify the current stock price. That's often an impossible hurdle to clear consistently in the real world.
Position accordingly. Stay humble about predictions, and remember that gravity in markets eventually reasserts itself. True success in this environment likely depends not just on riding the AI wave, but on whether you are positioned to survive the inevitable repricing when it comes, and then capitalize on the long-term transformation that AI is almost certainly bringing.
A sobering but crucial perspective. Focus on survival and selectivity. See you all in the next Pro Ticker Deep Dive.